rates for a reasonably long time. We have been feeling under the shadow monetary policy discussion that the interest rates are taking a little longer than usual for the downward adjustment. And the reason was very simple. Probably as well as what Trump is trying to tell Paul. Probably saying that the housing installments are too expensive. And of he's saying that it should be 1% from the 4% where it is now. But our reason that I had been saying, and to some extent Professor Goyal also had joined, was if we are looking for a Viksit Bharat, we need to have a very conducive interest rate environment in the country. So today we thought the governor has done a quantum leap in the interest rate adjustments. Professor Goyal is chairing the session today. She knows the system from inside out. And more than that, Governor made a recent statement where he said that we could probably be more accommodative and not, this is not probably the last stop. So then the issue is that we are at the cusp of a Viksit Bharat, as everybody calls it, the Amrit Kal. And we have the capacity to grow rapidly because we are in the midst of a demographic dividend, which is not going to last forever. According to projections, only till 2046 odd. Then the old age, of course, sets in. 8% of the Indian population is above 60 years. Given this quantum jump in the interest rates, is this going to be growth oriented or how is it going to pan out? So we requested Professor Goyal to chair the session and to our economists, again at the suggestion of Professor Goyal, an economist from the bank, Madam Upasna Bhardwaj, and an economist from the market, Arjun Nagarajan. They are familiar faces at EGROW, but let me just give a very brief introduction. Professor Goyal, most importantly, is our advisor at EGROW. She has been also the member of the Monetary Policy Committee of the Reserve Bank, and she was also a member of the Prime Minister's Economic Advisory Council. And for many years, she's been a professor at the Indira Gandhi Institute at Goregaon, Bombay. Madam Upasna Bhardwaj is with the Kotak Securities as chief economist from 2022. She has formerly worked at ING Vyasa Bank, an economist from 2011 to 15 at the Energy and Resources Institute, as a research associate from 2003 to 2005. Our next speaker for the day is Mr. Arjun Nagarajan. He is chief economist, Sundaram Mutual. He has over 30 years of experience in the field of economics, and his primary responsibility is to ascertain future macro trends and impact on domestic and international markets. Actually, one of his articles triggered the thought, and we requested him to come and present his research, which he has again followed it up with another brief article. With this, I hand over to you, Professor Goyal, to take the proceedings further. Professor.
Thank you, Dr. Singh. So it's really, in the tradition of EGROW, is very topical and in-depth and interesting seminars. This is really a very important issue. First, interest rates have been cut, policy rates. So can they help growth revive? Second, will the policy rate cut be transmitted through markets, through banks, fast enough, adequately to affect aggregate demand, household expenditure, investment, etc.? So our bank and market economists will help us see what is happening there. But overall, I've always had the view that the interest sensitivity of demand in India is very high, precisely because we have so many young people who are getting jobs and getting credit and buying things on credit, including housing. The RBI focuses on inflation, where when inflation is driven a lot by supply shocks, where the government can do more. But over the last few years, we've been seeing very good coordination with government action on the supply side. We've seen inflation come down. So therefore, the RBI can focus on stimulating demand. We saw that last year there was a tightening and growth has slowed down. So the circumstantial evidence is that monetary tightening does affect growth. Higher real interest rates did have a negative impact on growth. So for the pass-through, currently there's some really interesting issues because we always looked at banks for passing lower interest rates or tightening the reverse case. But as the economy has changed, as the financial markets have financial system has diversified, the share of market borrowings is higher, equity as well as debt which is interest sensitive, and we see a very fast pass through the market rates, especially at the shorter end, because that is more sensitive to liquidity. RBI has also injected a lot of liquidity. And in the long end also, we've seen that in 23, 10-year G-Secs were around 7. Now they're nearer 6. So that means that the good corporates can borrow from markets, the highly ranked corporates. In fact, banks are finding that they're not able to make the customary loans to corporates, but still they have a very large role to play in terms of enabling corporate functions, working capital, etc. So banks also are borrowing from markets. They're not only dependent on deposits for funds, and that is helping pass through. There was a worry that NIMs will contract and that will hurt bank profitability because deposits take longer to adjust downwards. But the large liquidity, etc., has helped banks. Future CRR cuts will again help their profits. So, and the higher business growth in credit, we are seeing that the growth of deposit and credits has been converging when earlier deposits were growing slowly. So therefore, those worries are coming down. But there are still some structural issues that might delay credit pass-through, which is that after the pandemic, there was a huge borrowing splurge by many middle class and low middle class households, and they are highly leveraged. The RBI had, in response, increased risk weights for MFI and NBFC borrowing. This has now been cut. And there's some signs of deleveraging among these households. So you could see a new lending cycle start, but it might take some time. And I think at present it is housing loans and MSME credit which is showing the fastest growth. But we look to Upasna to give us more details on this and how it's going to work. And as I said, markets, the pass-through has been very fast to corporate bonds and short-term borrowing, but from which banks themselves are benefiting. But the other issue is the international volatility. And here again, Arjun will tell us about markets and this. And I think one positive for India is that with Trump's various, somebody sent an article saying, has Trump become part of the furniture? So have markets sort of factored in this volatility and learned to look through it. It's also dented American exceptionalism. So we are seeing that actually American yields are going up, but at the same time, that's not leading to large outflows from EMs. So I think Arjun has talked about this, how this is a good time because of these, where we are a little immune from the outflows that you might see if interest spreads narrow. So you look forward to listening to them now. Upasna, you'll go first. Yeah.
Yeah. Hi. Am I audible? Yes, thank you, Dr. Goyal. I think right at a point wherein we have to question a lot of things. In the current scheme of things, in this very calendar year, we have seen a whole lot of aggressive actions when it comes to monetary policy, and something very unprecedented, I would say, because in a very quick or a very short span of time, we have seen lot many measures that have been announced in order to ensure that growth is adequately cushioned for. So to begin with, of course, we all know that, aggressive, the biggest sore point, I would say, for the banking system, which was there, has been, tight liquidity conditions until, late December. And then slowly and slowly that turned around. We have seen very aggressive monetary easing measures, liquidity easing measures by RBI. And I think at this point where we stand, now the question comes is, despite such aggressive monetary actions, are we going to be seeing a 6.5% growth? Or, is it that without this, we would be at much lower level growth? And hence, so, that question of what the potential growth for the economy is, and, that gap, is it being bridged through at the moment aggressive actions and more actions need to be taken? Or we should question whether the monetary policies levers are limited now incrementally, because the interest sensitive sectors, there's a limit to which monetary policy tools are cyclical in nature. So now when we look at growth and the issues associated with growth, or the output gap which is negative, can we really address through monetary easing incrementally or not? I think these are some of the questions which are important to address. Now, of course, all of this falls with a certain backdrop in mind. We have to look at how fundamentally the economy is doing, both from the inflation and the growth side. Obviously, the inflation story is looking very benign for the next at least 8 to 9 months for sure. Now, beyond that, there are two ways to look at inflation. One is the statistical impact, which is going to definitely cause inflation looking not so comfortable from a MPC's perspective, probably because, inflation starts looking higher than 4%. And hence, is there room to act now and then pause later? So upfront, furthermore, whatever we can, basically. So I think where I see all of this happening is, I would agree, Dr. Goyal, I think it's not just the bank credit we should look at, or the bank rates that we should look at from the transmission perspective. We have seen a very big shift that has happened in the market rates. So we are seeing a fair amount of correction in corporate bond yields. The 1-year CP rates have fallen about.
Can everybody else hear? We can't hear. Charvin?
Am I audible?
Yeah, now you're audible. In the middle we lost.
Okay, sorry. So I think, the commercial paper rates have, or the yields have fallen by about 125 basis. The 5-year corporate bonds, if we were to benchmark that, because long-term borrowing, investment and other purposes, that too has fallen by 65 to 70 basis from the peaks that we saw. Now, I think this clearly shows, and of course, I'm excluding the absolute shorter end of the curve, because that clearly mirrors the monetary easing and the liquidity easing measures. But more so from a borrowing perspective, the cost of borrowing has come down dramatically. And at the same time, I thought it would be interesting to look at overall system credit. So when we talk about bank credit, it is slowing down. But what is happening to the system-wide credit? That means how the NBFCs are lending, how the corporates are borrowing through the corporate bonds or the CPs leg, or the ECBs. If we look at all of that together, for FY25 also, there is a reasonable slowdown. FY24 was growing at around 15-16%. This consolidated system-wide credit, that has come down to about 12% in FY25. In FY26, we expect this to further slow down for various reasons. But I think another interesting trend in the credit cycle is also which probably also mirrors the way the growth model is evolving, is that the credit mix is more in favor of retail credit as against corporate. So we have seen that most of the growth that we have seen in the last few years has largely been led by the personal loan category, the retail category. And instead, I would say that pre-pandemic, when the share of the total pie of system-wide I'm talking about, this includes NBFCs as well. So if you look at the share of retail credit in the overall credit, that used to be around 30%. That has, this is like FY19, FY20 period. That has surged to about 36.5%, 37%. The corporate share has come down. This is obviously mirroring the lack of private capex, which has been there. Even the bank credit itself shows that, MSME sector is doing well. We are still seeing a lot of traction in loans growth to the MSME sector. But apart from that, the large corporates and all, the balance sheets are very heavily deleveraged. They're sitting on a whole lot of cash. There is no need to borrow, really. So entire mix is in favor of retail still, despite the RBI clamping down on, unsecured lending, etc. Overall mix still remains in favor of retail. The retail growth overall, again, still is holding up significantly well. While the bank credit side, we are seeing a moderation, but if I combine the NBFC plus, the banks together, then I think FY25 has seen a decent holding up of the overall credit portfolio to the retail segment as well. Now, going ahead, I think from a transmission perspective, we haven't really seen overall the transmission leg takes a while, because largely, while we are in an external benchmarking system wherein there is a certain segment which sees a direct impact, but on fresh loans, we are still not seeing, the impact of the 100 basis of repo rate cut. So that is number one. Typically what happens is the time deposits, the higher costing time deposits over the last 2 years, that itself will wean off only over the next 6 to 9 months. And that is when we can expect a complete transmission to happen. So I think that is where what becomes important is sustainability of the current comfortable liquidity and monetary easing conditions. We do need to see adequate liquidity, adequate monetary easing through the course of next 1.5 years at least, to ensure that the entire pass-through takes its way out and it starts really bringing in positive impact on the credit cycle. So I guess what I'm trying to say is a lot has been done, but the impact of that is still some way away. We are incrementally seeing in bits and pieces some parts, but if I look at the high frequency economic data, that is not looking very promising. So we are looking at a GDP growth this year at 6.2% actually, with risks evenly balanced on either side, largely because global uncertainties also need to be kept in mind. So I guess, with the excessive amount of a negative output gap, inflation being in check, there is more window to act, but only at the margin. Now, the question is whether you should further upfront it or wait a little bit more for transmission to happen. So it's a matter of timing, is what I'm trying to say, between the coming policy or the next policy, wherein I do expect 25 basis to maybe 50 basis of further reduction before we close the cycle at 5% repo rate. But having said that, I think very importantly, RBI is, managing the MPCs, what their objective is to keep the weighted average overnight rates closer to the repo rate. This is where I would say in the past, we have seen stealth easing and stealth tightening take place, which always caused a lot of confusion. Now, I think we are moving towards a point wherein this entire approach is shifting towards the fact that even if monetary easing or rate cuts are happening, the overnight rates should probably be necessarily anchored to the repo rate. And that's one thing I say is a positive development. Should happen like that because it avoids a lot of uncertainty in the market. And that takes care of a whole lot of other disruptions which would come to transmission. So overall, at this point, I would say that interest rate cuts can happen, and I really don't against. I would like to emphasize. I think in the previous forums I also said at this point we should not unnecessarily pay too much heed to the interest rate differentials. I guess both the economies, US and India, are operating on a very different platform today. So maybe because of the high negative output gap, we can see continued comfortable monetary easing situation for a longer period of time. But having said that, I would also like to emphasize that there is a limited scope for monetary easing to support growth beyond the point. So that is where the fiscal policy will play a very important role. In its own capacity, in this budget, we've seen income tax cuts, but it only affects a certain segment. I guess from a long-term perspective, there are more fiscal reforms which will be needed to really bring the economy back to a 7% plus growth. I don't think we should rely on the monetary easing side to really bring this 6.5% growth towards a 7% growth. That's it from my end for now.
Okay, thank you, Upasna. So I'll just maybe it would be nice to have some discussion on the interesting points you made. So let me just make some responses, and you can respond further. I think we have time, so then we go to Arjun, markets, and so on. So, this issue of fiscal action, that's very, very important. I absolutely agree, because fiscal action affects the potential output, fundamental drivers of growth. And that has to continue, infrastructure, et cetera, et cetera. But what monetary policy can do is ensure that output stays close to potential, the cyclical part. And this is related to the question of easing now or later, because if they had forecasted inflation correctly, and because monetary policy acts with lags, and as you're saying correctly, stance has to be sustained the policy has to be sustained for at least a year for the full effects to transmit. So if they had, in the last year, the last 7-8 months of that year, policy was too tight. So because of that, real rates are too high now. And we need to bring them closer to the neutral rates in the current situation for growth to adjust to potential. Therefore, you need a faster adjustment. And what the governor or this MPC has done is absolutely correct, to move in big steps to take the real rate closer to the one that will ensure growth at potential. And this issue of, it takes 1.5 years, that's true. But as you're saying, market rates, transmission is much faster, and the cost of borrowing has fallen for a whole lot of borrowers. And that has a positive effect on it. As Charan was saying, that we need to be able to spark more housing, borrowing for housing, et cetera, et cetera. I think that is starting to happen because they're market-linked borrowings also. So some positive effects start, and in some ways, because of the change in the market structure, the larger share of markets, the EBLR, the external benchmark lending, etc., transmission is faster today than it was earlier. So, and this issue of retail dominating and therefore and retail being in a deleveraging mode, etc. I think we're such a large country that even if some borrowers are overborrowed, others are not. There are many who are potential, are good asset quality, the loans given to them. And corporates, we saw this all through the MPC, and we're seeing it now. Just recently, Ms. Chandra, the Tata Sons chairman, has been talking about how Tata invested 5.5 lakh crores over the past few years, and that has allowed them to leverage growth, giving them much higher growth. And he calls it, very interestingly, not investment, but spending to get future ready. Now, I think sometimes we don't realize the ways in which corporates are spending to enable them to grow and participate in the Indian growth. And those corporates that are doing this are doing well. So in different sectors, there is a lot happening. It's continuing to happen. And this deleveraged balance sheets, high cash, and ability to tap bond markets means corporates can start investing without coming necessarily to the banks. But as their business expands, they always need the banks for working capital and so on. So that's business for the banks, and that increases credit in the economy, etc. So I think the different parts of the market act together and enable faster and better, safer, more stable transmission. Yeah. If you'd like to respond to any of those comments.
No, I would agree. I think here, largely what is happening is clearly the market responses are normally front-loaded. They tend to be much faster. So the transmission is always faster there. And that is the reason why the credit mix changes also immediately. You know, we tend to see whatever little borrowing is required by the corporates, they tend to move towards, you know, the corporate bond markets in such kind of cycles, because they tend to take the opportunity of borrowing at lower rates. Obviously, the banking rates will be slower to adjust. And that is the reason why we tend to see this change in the credit mix in the short term. In the long term, obviously, you know, right now what's happened is if we look at the capacity utilization rates, I mean, you know, while speaking to clients as well, we do realize that while in pockets, of course, you know, some big capex does happen, but we are not really seeing a very blanket kind of a pickup in capex cycle. And also that a lot of clients are telling us that they are not sitting, I mean, they're sitting with a huge amount of capacities, which also means that there's no need for them to expand at this point, especially because despite whatever support that has been provided through monetary and fiscal, there is uncertainty. Now, because of uncertainty on both demand domestically as well as globally, there is that element of uncertainty which is pushing or deferring it more and more. So that probably makes it difficult to have you know, corporates coming back with a big bang. But I would agree that the order or the sequence of borrowing through from the banks is going to be last. You know, at this point, they're sitting on very robust balance sheets, significant amount of cash, the larger corporates. As a result, till they don't wean out of that aspect, they're not going to be coming out. But we need to keep in mind that the capacity utilization is just static around 75% for the past so many years. You know, it's been straddling between 73% to 76%, I think, here and there. Till that doesn't change materially, I think it's difficult to expect a private capex-led recovery. At this point, we are only talking about largely a consumer-led growth, consumption-led growth.
Yeah, absolutely. Let's hope that the thing is correct, that Trump is becoming part of the furniture and corporates also look through volatility. Because I think if you are a forward-looking, like look at the Tata, you know, Tata Sons chairman, I mean, if you are forward-looking, you're building for the future, you know India's on a higher growth path. You can't wait for your capacity to rise to 100 before you invest. Investment also takes time. So you have to start now. And in certain sectors, they're doing that. But another factor I've heard, which is interesting, is that currently, because of less delays and so on, investment fructifies much faster. You know, with outsourcing, you can get buildings from these commercial companies. You don't have to build yourself, etc., etc. So investment, the lags are lower. Maybe that's why also.
Yes, absolutely. I think that gives them the capacity to wait, as in wait for a little more, probably.
Yeah. Okay, so Arjun, we are waiting to hear from you about how markets are helping the pass through.
Yeah, sure, ma'am. I have a few slides. Is it okay if I share them
Yes,
on the
please,
screen?
please go ahead.
Just give me maybe I'll take around 7-8 minutes. I'll just roughly share the framework that we have in mind. If somebody can help me, I love sharing. It says content sharing not allowed.
You can do it now.
Perfect. Thanks a lot. You should be able to see my screen if anybody can confirm that.
Yes, we can.
Perfect. So
yes, we are able to see.
Yeah, I'll just broadly sort of outline how we are looking at things. I'm keeping that skeptic in me a bit behind. So the last couple of months, I've been a little bit more optimistic given how fast things have been turning around. Nevertheless, the skeptic in me will sort of peep in now and then. So this is broadly from a GDP point of view. Two things that we keep telling clients also is that, see, if on April 2nd, if Trump had actually come and announced saying that they're going to put a 50% tariff on every single country and for the next 10 years, it would have been very negative for markets, but the markets would have figured a way to sort of come out of it. The problem this time around is not the how high the tariffs are, but the fact that one is not able to figure as to where the tariffs are going to settle. One day it's a double digit number, the next day it comes down to a single digit number, the new tariffs keep coming up. It's an uncertainty that keeps bothering the markets rather than the tariff in itself. So if the tariff narrative sort of ends, which we are sort of guessing by November, December of this year, it should, because November of 2026, he has midterm elections coming and he can't really afford losing seats on the lower house because that will really impact how he can pass bills in the United States. So the quote that keeps coming up in my head is what Juncker, the former European Union president, once said. He said, "As politicians, we all know what the right thing to do is. What we don't know is to do the right thing and come back to power." So that equation will always play in the heads of every president in the United States. So from a GDP driver point of view, given the backdrop of uncertainty, I think net exports and investment doesn't look like is going to be a very significant incremental driver. Government spending, the center's government spending, I don't really think there's going to be any disappointment there. But the quality of state spending will take a hit, given that you have elections, 3 elections in the next 2 years. You have Bihar, you have UP, and you have Tamil Nadu. So that I think the quality of state spending, given that state is a larger share compared to government spending, central government spending, I think that can see a compromise. The segment that really stands out very strong is private consumption. So broadly, we've sort of laid out around 8 reasons why we think these are structural positives for private consumption, of which the top 2, income tax cuts and RBI rate cuts, and lower crude prices and the 8th pay commission. I think these 4 can be fairly sizable positives from an India macro point of view. Income tax cuts and rate cuts always help push up urban consumption. So urban consumption, if I look at a proxy as listed companies' salary growth, it was around 22% a couple of years ago, 3 years ago. It's currently at around 5% or so. So I think that will bottom out in the next couple of quarters and start moving up thanks to these 2. Lower crude prices, we started the year at around $85 a barrel. We're currently well below, just under $70 a barrel. So roughly around a $15 drop. So 65 to 70, I think, is the range at which crude is likely going to stay, which means at least on the incremental, from a corporate point of view, I think gross margin expansion can happen to a marginal extent. Nevertheless, it's actually a decent comfort compared to where it was a couple of quarters ago. The pay commission, at least the last 1 week, there have been news flows indicating that it might get a little delayed. I don't know if that is an election tactic, but nevertheless, let's assume it starts, the pay through comes off, let's say December of 2026 onwards, optimistically, which means at least for a 3-year period, you will see a decent consumption support for the economy. So central government employees roughly around 12 million, PSU employees around 1.5 million, and state government employees around 11.5 million. So all put together 25 million, 2.5 crore government employees can benefit. So the pay commission is, the 8th pay commission is only for central government, but invariably immediately after the central government, you see PSU pay commissions getting implemented, and then state pay commissions getting implemented. So within a 3-year period, let's say optimistically 2026 to 2029, you'll see roughly around 22.5 crore Indian government servants getting a decent sort of an increase in their pay, which will definitely be a positive from a consumption point of view. Now on the transmission, I think the biggest and my most favorite chart is this, where you break down in the scheduled commercial banks loan book, 25% is fixed rate loans and the rest of it is floating rate. And if you break down the floating rate, you can see that under 3% was your EBLR framework, of the number of the percentage of loans under EBLR was less than 3%. It's currently, if I update this to the March number, it's almost 62%, which means it has reached that threshold, and you can see that transmission this time around will be much better than the transmission that you saw earlier. So the quantum and the pace this time around, I think, might be better. So which means EMIs will come off faster and by a decent margin. This seems to be a positive. Now, if I break that number down into public sector banks and private sector banks, it's quite surprising as to how the private sector banks, nearly 87% of their floating rate loan book is just EBLR. And they've really grown this EBLR book at a much faster pace. So this is something that really stands out. And within that, this is some data that came out in the latest RBI's financial stability report. So one segment that immediately comes to one's mind is retail loans, rather personal loans. If one breaks down how fast they have grown in the past, FY19 to FY25, they grew at around 18% CAGR, higher than around a 16% CAGR that they grew in the 14 to 19 phase. Now, within this bucket, if I try and see how much of EBLR loans bias there is, you can see the orange lines here. You can see housing, education, and total retail loans largely have a EBLR loan bias, or rather a private bank bias, particularly education and housing. So these two appear to be segments that then one can logically say that could see a decent impact from the pace of transmission, which is likely to be better this time around. Now, about rate transmission, just broad numbers here. So we're trying to see if we can do a more detailed piece on this in the next month's monthly. Roughly around a 3/4. If I look at the RBI's rates and how long it actually takes to translate into weighted average lending rates on fresh loans within so by end of August and September, I think the entire 100 basis points of rate cuts of the RBI should start reflecting in your EBLR loans. But then this interest rate to translate into the economy, roughly around, it looks like around 3/4 or so is loosely what it looks like. If I break it down into segments, somewhere around services takes around a year, retail takes around a year and a half, education under 1 year. But the most important, and something that Dr. Singh has been highlighting for a while, has been the small and the medium segment. The impact starts almost immediate, within a couple of months, given how sensitive they are to changes in lending rates, especially these micro and medium enterprises. So that, I think, will be also a decent support from a macro point of view. Now, quickly, a couple of other pointers. We don't really know exactly. I'm just sort of guessing here. There is likely to be a liquidity framework that the RBI is going to come out with. We don't really know when, but sometime soon. There have been commentary that one can pick up from RBI governors' speeches as well, talking about how this 3%, so this 3% CRR came as quite a big surprise to us, because it's never been 3% from the time the CRR was initiated. So some indications probably saying that maybe this 3% is going to be a new normal, given how there has been a sharp increase in digital payments, 24-hour settlements. Maybe this is a new normal that the RBI is sort of recognizing CRR should possibly be too. There's been a very clear commentary. I think Upasna also made a mention about that, talking about how the target rate is probably going to be the weighted average call rate. And that's something that we can see in RBI actions as well, where they're trying to tweak it in such a way that it comes closer to the call rate. There have been some noises talking about maybe given that the volumes under the call rate seems to be much lesser, do they want to move it to a more secure benchmark? That is another commentary that has been doing the rounds. Is that shift going to sort of happen? The other bit, it does look very clear that the RBI wants excess liquidity, and you look at past cycles, two variables stand out. So one is whenever you've seen a fair bit of an increase in domestic liquidity surplus, you've always seen transmission to be much better. The other instance where you've seen transmission better is when credit growth starts coming off, your credit to deposit, incremental credit to deposit growth ratio, when that starts coming off, which invariably means that there isn't too much of an increase in credit. At that point in time, also, you're seeing an increase in rate transmission. So these were a couple of other pointers. And last two pointers that I wanted to just throw it in there to get comments as well is, we have been seeing a lot of money with corporates. So the demand for credit from corporates, to some extent, is not really picking up, also because of the fact that they have a fair bit of cash with them. They are delaying some capex. So there isn't too much of incremental demand from them because they already have a fair bit of cash and they're not really reinvesting it anywhere at this point in time. So maybe, at least for the time being, should we look at a better variable, a more aggregated variable of credit growth? That is just one thought that I'm putting it out there. Second, I agree with Ms. Bhardwaj about how your growth rates are going to be lower. So I think 6% plus is in and around what FY26 is likely to see. And given that inflation also is going to be well below what the RBI is projecting, I would think another rate cut is definitely round the corner. I might want to think, given how the RBI governor has delivered the last few rate cuts, where the minute he sees space, he seems to deliver and then say, I'm done, in a sense, front loading all of it and giving the time for transmission. I would want to bet and think that maybe August could see a 25, and maybe he might not wait for. He already had made an indication that, see, in his in a couple of speeches ago, he said if inflation comes off, there will be space. Inflation has come off. Immediately after inflation came down, he made one more comment. He said, if inflation comes off and growth is lower than our expectations, the RBI's growth rate for 6.5 is fairly on the very optimistic side for FY26, which means it seems likely that I think both these numbers can see a reasonable downward revision and a 25 basis points rate cut. There's a significant base effect that will peak by around September, October or so. And if he does want to deliver cuts, I think that's the best time he can deliver in such a way that there is front loading, and he will not be in a hurry to sort of unwind it anytime soon, which means that the rate cycle can probably be also extended for a fair bit of time. And last bit, I always harp on the currency again. So my concern on the currency is still very much there. Given that if they deliver another rate cut and there isn't anything significant that you see on the Fed side on the rates front, I think the currency pressure will keep coming up. My only concern is more than the current account FAZ or anything, is only the financing of it. So two things that can change it is if there's going to be a fair bit of an equity focus in India's favor. I think that financing part of it will be taken care of. If that doesn't happen, I think net FDI number is a single digit number, but what people miss out and see is that if you look at the gross number every single year is much higher. The reason it is net a very low number is because of the repatriation. So if for any particular reason the repatriation sees a very sharp sort of a drop, then the financing from a FDI point of view also can sort of open up again. Last point I just mentioned, one thing, if at all, that really is going to be very, very positive for India would be if crude continues to remain soft. If it moves lower, closer to the 60 handle, I think that will be the best thing that India can ever see. Just one simple case in point, I'm just taking one simple example of June 2014 to February of 2016. when you actually saw a very sharp drop in crude prices from $112 a barrel to around $32 a barrel, roughly around an $80 per barrel change. Just listing out all the variables that just one single variable made an impact. You saw lower imports, you saw lower inflation, you saw lower WPI inflation, and that lower input inflation actually caused a very sharp increase in your GDP numbers, your gross margin of companies, your repo rate. The RBI was able to cut rates when the Fed was actually raising rates. So it gave a completely different domestic angle to the rate cycle for the RBI. FDI inflows started picking up, equity, debt inflows, FX reserves started getting better. The government did not really pass on the drop in prices. It actually increased excise duty. Because it did that, it was able to really bring down its fiscal deficit. Interest as a percentage of GDP came off, and that excise increase, a good part of it, it was able to even trickle down into capex, where they sort of pushed up capex by 0.2% of GDP. So just one single variable. So if that also happens in addition to all that we've been speaking about, I think it will be quite great for India. I think I'll stop there. I've spoken for much longer than I thought.
Thank you. It was so good to see the skeptic in you is shrinking. But let me play the skeptic a little, since you're not doing too much of it. So this if you're saying that inflation is likely to be low and that gives room and so on. But they could just as we look through a spike in vegetable prices. If this is a fall, it's a temporary, transient fall. Then the governor has quoted, and RBI is going to. I don't know what your forecast is for inflation next January, next Q1 and Q4, because they see it coming back up to 4.4, 4.5, and so what is your forecast?
Yeah,
because in that case, there's not so much room to cut, right?
You're right. So I'm very comfortable with just one rate cut in August. Beyond that, going more than one rate cut, I feel might be a little difficult, because like you're saying, in case these three vegetables start moving in the other direction, then I think it can really question RBI's credibility to a certain extent. So my forecasts are all ballpark. So just these three vegetables can turn the entire trajectory around. So, so 25 is all that I'm comfortable with, not more than that.
Yes. So this issue of like Upasna was saying, what is your view that once you reach a certain rate for transmission, you should stay there, you should not reverse? Because this argument about that you need to get your real rate near neutral, it's been too high too long, so you need to make upfront adjustments. Yeah. But then if you're being forward looking and you see inflation rising next year, so if you need to reverse, is that a negative for markets? If you're at neutral, suppose you cut in August, and if the worst case scenario, inflation rises next year, if you want to raise in, say, February, is that be a negative for markets and for transmission, or is it okay?
Yes. So I would only hope that the rate cut cycle is extended. If it does turn around in January, I think it would definitely be not a very great positive from an equity markets, or rather a market's point of view, because it would have barely been 1 year of a rate cycle per se.
No, so you're not reversing the cut, in the sense you're not raising more than, say, maybe 25 BPS. So why is that? Because like I like to say that the Indian economy with diversification, market deepening, etc., and with inflation volatility, at least for headline, coming down, right? So kind of adjustment in interest rates is much lower now.
Okay, let me put it this way.
So that means you're fine-tuning to reach, and that fine-tuning means you might have small steps in one or the other direction. But overall, it would be a softening, right? It would be a cutting.
Yeah. So drivers per se, I don't really see too many strong drivers of growth into the next couple of years. So exports and investments, I don't really think are going to be quite significant drivers, and quality of government spending also I can't see as a significant driver. So it's only consumption. Consumption of which a very strong structural driver is pay commission, which we have no idea when that will start implementing. There's the last couple of weeks, you're seeing only more postponement. It looks like they might want to push it closer to the elections. So then we are only dependent on two variables, which is tax cuts and rate cuts. Those two as what do you say, separately, I don't think they're strong enough to turn things around in a very big way. So I feel the recovery is going to be fairly slow. Also, given how tied up we are with global growth as well. So last year we had global growth at 3.3. India was around 6.7. So roughly around a 1.82x sort of a multiple. I don't think global growth in 2026 is going to see a sharp pickup. It's going to be in and around that 3 handle, which then means that we will not really see a very sharp pickup in growth from that driver as well. So both domestically and externally, I think it's going to be a slow wicket for India. So I would hope that the RBI also gets a long rate cycle of a long rate cut cycle.
Yes, I mean, low rates are going to persist for long, but they just need to ensure that real rates don't fall much below 1 in terms of forward-looking inflation.
No, fair enough.
As long as it stays at that level, that is what matters for consumption, investment, so yeah.
And there was a comment by sorry.
Markets look more at nominal rate. A nominal rate cut, if it's aiming to keep real rates at a level which is good for the real sector, the long term should be positive for markets also, right? They look through the nominal changes towards the real stance. Yeah.
No, fair enough.
And then there's just one, maybe if I can share some slides very quickly on this currency issue. Yeah, the other point I wanted to make was about time. You'd said, that I agree absolutely that we have to give time for policy to affect. Yeah. Many people say, I think what happened in 2011 in India, for example, was 11 rate cuts and no effect, 11 rate hikes and no effect, so hikes are more. But those hikes are going to take 6 months, 1 year to have their effect. Now, if you're saying we want instant monetary policy, transmission is highly effective in India. It has a law, but it is not instant. It takes time. And, this choice between small steps and a large upfront is, as I said, when you're adjusting towards equilibrium levels, you've deviated from that because you weren't sufficiently forward-looking in the past, then you need to move more rapidly in the present. And also because then you can have a larger pass-through, faster pass-through, but still it is not going to be an instant pass-through. So you have to wait, the pressure that do more, can lead to overreaction and therefore more volatility. We need to reduce volatility. Charan, have they enabled sharing for me? Just two, 3 slides I want to show figures for Arjun's this currency dilemma.
Sure. Vivek, just permit Professor to share.
Upasna, you have any, or Charan, you have any comments on the presentation?
Just permit Professor Ashima to share some slides. Professor, we are just allowing you.
And another, I'll just talk about some of our experience in the MPC. I absolutely agree with both you and Upasna that keeping the market rates near the repo, it's what's mandated by the inflation targeting framework. And in the last MPC term, we very often saw liquidity tighten and rates really move away from the repo. That hurt markets. We used to keep raising this, but, so they would keep saying government, they are keeping too many cash balances. But the point is that you have to adjust durable liquidity to take care of those exogenous shocks. And maybe they're learning and planning to do that more effectively in the future. So that's certainly a comfort for markets, and more certainty, as Upasna was saying. Meanwhile, Upasna, you have any questions for Arjun or Charan? You have any questions for them while I share the slides?
Upasna, you are muted.
Upasna.
Am I audible?
Yes, yes.
Small comment. I think, front-loaded action by RBI is also has been plausible because I think the global situation, especially on the dollar index, if we look at, all of that has been very supportive. So even though Fed is not cutting rates, I think the comfort that we can draw is that, overall we have seen rupee remaining comfortable. The dollar has been softening. And that is one thing which will still be important to keep in mind, irrespective of whether Fed cuts immediately or not. So going ahead, I think currency, I'm not that bothered really about, because I think currency is fairly valued. It's moved reasonably well. And I agree to an extent that financing of the current account deficit will be important. But current account deficit is so much in check right now, $40 billion around, plus minus a little. Compared to where, we've seen very huge numbers in the past. So now I think a combination of ECB's banking capital, even if FIIs is, or if FDI is minimal, all of that is not that difficult, is how I would put it. So, balance of payment is not really such a big challenge, as long as, of course, crude remains in check, which is clearly looking like to be the case. So I would be more worried if the sanctions bit on Russia and hence BRICS economies, all of that will be a bigger risk for India rather than a dollar.
No,
Yeah, Arjun, if you'd like to respond.
Yeah, no, I completely agree. So structurally, I do agree in the sense that we're getting to a much lower current account deficit. It's coming to a much more manageable levels. My only issue is only around the financing of it, in the sense that if I look at the items that finance, so ideally, let's say a 25 or a $28 billion current account deficit annually should not ideally be much of an issue. But if I look at FII flows, if I look at debt market flows, if I look at FDI, all of them, if I add them up, it's not even coming to around a 25 or a 28 at this point in time. So given how, if I look at FII in debt, I don't think FII money is going to come into debt into India as long as US remains elevated, because even on a completely hedged basis, the spread is actually negative. So I'm taking that out of the equation. Then equity, nobody really seems to know how the flows are going to turn around. FDI, it's still in single digits. So if I add all the numbers up now, I'm still not getting even to a 25 or a 28. So it's only the financing that I'm a little concerned about. Structurally, I have no concerns.
Yeah, please finish. Please go ahead.
Yes, no, so structurally, I don't really have too much of a concern. It's only the financing, given that I can't see too much of visibility into FII and flows into equity and debt, and FDI being at single digits is sort of raising some orange flags for me, if you may.
But it's true, the current deficit itself has fallen. Yeah.
Yes.
And I think the repatriations, etc., continue to be NRI flows. So can you see my slides now?
Yes, I can.
Can, right? So
yes.
Here, this is just showing you how the spread of the GSECs and the repo over the 10-year and the repo over US rates has fallen. Yeah. Repo over the Fed rates and 10-year over the US 10-year rates. Yeah. So we agree that it's really fallen ever since 23.
Yes.
And then the second graph shows, now here this is showing equity and debt flows. Now you see those spreads are really narrow since 23. And that is when you see debt flows, the red line really recovering, rising. Yeah.
Mm-hmm.
Despite narrow spreads, I think in 2020 we saw a large outflow, debt outflows, and after that it was more or less flat around 100 billion. And then total stock. And then we saw recovery and return when the spreads were really narrow.
Mm-hmm.
So one way to understand this, of course, one way to understand this, I think, is this third graph, which is showing you how the spread of over policy repo rate for both short-term T-bills and the 10-year G6 has steeply fallen from 23 for these, the red line, yeah, where my cursor is. Yeah. And, because the big puzzle was that during the pandemic, policy rates were at 4, but this spread was rising, G6 yield stayed around 6% and so on. And so one of the ingredients of that spread is country risk. So one way to understand this fall is falling countries' risk as macro stability has increased. Yeah. And of course, for short-term, Upasna, this is the bank liquidity effect. Liquidity was very high during the pandemic. So these spreads were actually negative. Yeah? They were below the short-term T-bills and so on. And while the long-term 10-year bring in all kinds of inflation expectations, growth expectations, and country risk is very, very important. So, for our pass-through discussion, I think what is very important is that it is not just the repo rate but the spreads through the market system. And important ingredients of these spreads, expected, UIP risk premium, expected currency depreciation. Now, all this comes down as the macros are more stable, as inflation differentials fall, and overall we are seeing this sharp reduction in spreads. Although one puzzle is that with that large 50 BPS cut in June, why is this red line going up? Why aren't Treasury G6 coming down further? So that might be this Trump uncertainty or whatever. But still, you see that it's much below what the spread was in 22. So overall country risk has come down. Yeah. So I just wanted to illustrate with a picture. I keep saying this, but now you can see it in pictures that falling spread and higher inflows have gone together, and that there's a valid reason for that spread to fall. Yeah. Without necessarily giving lower returns, because country risk has also fallen. Yeah. Okay. Yeah. So now, if you have any rejoinders to points I raised, you want to say something, Arjun? You're welcome. Otherwise, we'll open it to the house.
Yeah, I had one. I just wanted your view on this. So, in a recent interview, the governor made a mention talking about this neutral rate of 1.4 to 1.9. So, isn't that sort of an indication that probably he's also expecting growth to remain at a lower level for longer? Is that a way of reading it?
So during the pandemic time, the RBI had done an estimation of this rate, and it was around unity. Yeah. Then there was a second paper when growth rates really rose, and that was why I think the RBI got trapped in too much in tightening, because they thought growth is really robust and it's not going to, and they can focus on inflation and getting the target to 4%. At that time, the estimate of the neutral rate, factoring in this higher growth, raised it some to 1.4. But now, since growth has fallen again, it's at 6%, 0.9, and 10%. That effect goes, then the neutral rate comes down. It's at the lower end of the band. And
okay.
Yeah.
Okay. Fair enough.
And also, if we are talking about, there was over tightening, and then these effects take time to reverse, right? So this fine tuning I was talking about, it requires a little bit over loosening, right? Slightly, which means that you can go a little below 1, or if 1 is the neutral rate, or 1.4 if it's the neutral rate, and that is equilibrium, right? Because the neutral rate is actually where you're at your target and growth is at its potential. But of course, these things are not proper. It's very difficult to estimate them precisely. So they're always ranges. And that is why the other reasons why I think a real rate around unity is good, because it balances the interests of savers and investors. And I just recently saw one analyst who was saying that the rates have been above 1% in the Indian economy through the 2010s, but that was why we had low growth, because it was much too high, and that should give us the learning that we need to keep them somewhat lower, and we have the space to do so.
Fair enough.
Yeah. So now, are there any questions? Charan, you want to come in?
Yeah, I had a question for each one of you, starting with you, Professor Goyal. The chart that you showed towards the end, you see in the third chart, the band is really narrowed tremendously between the repo and the 10-year yield, right? And much more narrower now than what it was before the pandemic and before the whole thing. So what could be the reason for this real sharp narrowness between the repo and the 10-year? Professor, I don't know, should I ask the other two now?
Yeah, please go ahead.
Upasna,
Yeah.
one thought that comes to my mind is
Yeah.
the interest rates are down and obviously expected to stay there, as Professor Goyal was mentioning. Now, where do you see the investment going up? And do you think the ICOR, because for such a long time we had a very disturbed interest rate. We were at 4% at one point, and then we never went back there. And for a long time, we have seen all the highs. So, would you think that once the investment improves, now that the interest rates are low, and our ICOR could have probably improved, and we would have some advantage in terms of growth now? So, at the end of the day, we are only averaging 6.5. So we keep saying it as the fastest growing large economy, but given our demographic dividend, I thought we had a much higher potential, and we should have really grown at a much higher rate. So I don't know if some thoughts on that. And Arjun, I was only wondering if, as the expectation from the Fed to reduce their interest rates. Now, if they really reduce it, I'm not sure 1%, which their president demands, but I'm sure I wouldn't be surprised if the reduction happens sooner than later. And suppose they reduce their interest rates, then would you think the gap between their policy rate and our repo rate obviously will narrow down? And I'm hoping that the governor will, even if he front loads in August, if he brings down our rate, then do you think the compulsions and the pressures that you were mentioning about FDI and all those would then recede? Because my feeling is that the Fed rate has to come down. It's also too high and pegged too high for comfort for their own country. Leave aside other reasons. Thank you.
Yeah, Upasna, would you like to come in first?
I'm sorry, I missed the question. I got logged out. So,
Upasna, my question was very simple. The interest rate cycle that is now looking south and
Yeah.
probably would stay there for some more time is
Right.
certainly expected to boost investment.
Huh.
And would you think that given that boost in investment and probably a change in ICOR, this could help us catapult to a higher growth rate than the 6.5 with which we are on which we are cruising now? That's the question.
Dr. Singh, I think one important aspect of investment revival is animal spirits, I guess, and it's very important. So while yes, the environment is benign from all perspective, fundamentally we say good balance sheets, we say the ability of the banks to finance, all of that is in place. Demand to an extent is, I would say, the consumption demand is looking okay, just about straddling. As Arjun earlier said, at least 2-3 years prospects are looking okay because of 8 pay commission also coming into the picture. Am I audible? I'm sorry, because I have some major network issue.
Yes,
Okay.
you are.
Okay. So, so I think till we don't have absolute certainty, and just to put it in perspective, historically, the capacity utilizations do have to go closer to 80% to really start seeing a revival. I think that's where all of this together. So interest rates are benign, no doubt, but that itself in itself is not the only driver of revival. We need a stability from a policy perspective, from a global perspective. Till exports don't see stability, that itself acts as a deterrent. So I think at this point, honestly, if you ask me, next 3-4 quarters, I don't see a major revival in the private investment side. So the heavy lifting will have to be done by the consumers, by the government, in order to manage this, in order to manage a 6.5 around the handle growth, is how I would put it, despite the aggressive monetary easing that has happened.
Okay, now Arjun, if you would like to reply.
Yes, Mr. Singh. So, start of 2025, the spread between India RBI repo and the Fed rate was around 200 basis points. Now it's at around 100 basis points. Now I'm expecting a 25 probably around the corner. If that happens, 100 becomes 75. The Federal Reserve, as of now, is expecting 50 basis points of rate cuts in 2025. If that does happen, then our 75 goes back up again. Now, August 30th of July and August, I think, are going to be fairly important because one, there is a lot of pressure that is there on the current Fed chairman. So the US president has just gone and met the Federal Reserve chairman in his office, and this is the 4th time in the history of the US that this has happened. There have been some frivolous, I don't know if it is frivolous, but nevertheless, for the lack of a better word, a lot of new narratives doing the round saying that there is some accusation that they've spent more money on renovating the Federal Reserve building, etc., and they're trying to use that as a reason to oust him from office. His term is May 2026. So what I'm trying to say is that there's a lot of pressure on the Fed to cut rates at a much faster pace. At the end of the day, I would want to think from a practical point of view, no central bank is 100% independent. There is always a certain framework within which they will have to function. So I think the probability of a more dovish Fed policy is increasing in my mind, and it is also increasing in the eyes of the market. August will be very important. August Jackson Hole, I think, is going to be very important because any shift in policy, if at all, will be something that they will indicate there. So if there is a more dovish Fed that comes out in August, then to a large extent, my concerns also will slowly start receding because the gap between the Fed rate and the US and the India repo that will contract to around 75 or so by August will then start opening up again and come back up to, let's say, maybe 150 basis points by the end of 2025. If they do 25 basis points more than what they themselves are projecting.
Arjun, I've not seen the data, but what is the ideal spread
Yes.
between the two? The Fed
See,
Reserve and India's repo?
Around 4.5, 5 is the yield spread that I have noticed. I don't have the numbers on the actual policy spread. Around 4.5% has been US 10-year and India 10-year historic, somewhere around a comfort thumb rule is around a 4.5, 5% spread. The policy spread, off the top of my head, I don't have a number. But
So,
the only
Charan, if I can
Yeah,
add
sorry.
here, the average spread for emerging markets is 200. Yeah, and we've normally been above that. But for the first time in the recent period, we've come slightly below that. Yeah, 200 BPS we've gone to. But as I said, this you had this question to me also, no, about this sharp reduction spread. What? So if you look at that chart carefully, then you see that in 2015 also the spread was lower, but after that it rose. And that is probably because the 2010 decade was highly uncertain growth That's why I keep saying I think growth is really important to reduce country risk for an emerging market. And now the fall in spread is about equal to what it was in 2015. So it's not that it is that, but overall, I think more macro stability. And, so one of the components, one of the reasons, and the sustainable reason the spread has fallen is lower country risk, yeah, as well as lower inflation expectations. All that enters the yields of G6, so, but not the spreads.
Professor Goyal, you've
Yes.
been teaching international trade and you've been the thick of monetary policy. And Arjun has just reminded us of the drama being played in Washington, D.C. The president of the country going to the office of the Fed chair and the building they spent $2.9 billion in renovating and all that. We have all been reading those figures. Now, my quick question to you is, you as a macroeconomist, what is your assessment of the policy rate in the Fed Reserve? Is Paul stubbornly holding on to something which he should not have, or is that really justified?
Yeah, when I was in the MPC also, they had this IMF advise and higher for longer. For some time, there was this was a slogan, and therefore yields really went up, Treasury, the G-Sec yields, etc. The belief that that once inflation targeting, you've gone off the target, it requires a large sacrifice for and a sustained period of higher rates for inflation to come down again. But then subsequently, we saw inflation fall. Right now, because it's slightly sticky and because of Trump uncertainties, again, it's actually the rates are higher than long-run inflation expectation. And I don't think that should be the case at all. So they have space to cut, and they should be cutting. Now, I'll just quickly add to your questions to Upasna, and then we have time till 5. So there are a lot of questions in the chat box. We'll turn to those, and all of us can have Arjun and Upasna. Please read those questions. Any question you'd like to respond to last 5 minutes, you'll have to respond. Yeah. So Upasna, your question to Upasna. And so at this point are not well understood. So let me say it again and again, that in an economy like India in transition, we don't know what our potential rate is. We have large youth unemployment, our demographics is such, and they are going in for more education and training. We're seeing this apprentice program, they're not able to get people because people already have, so it's opportunities for skilling, etc. So we need to increase employment. We have capital flows. We can. So the constraint in a mature economy, you talk about savings and ICOR and so on being the constraint. But the idea of inflation targeting and responding to inflation. So if inflation is higher, it means there's excess demand. Apart from the supply shocks.
Yes.
Yeah. So then you need to tighten, raise your rate. So as long as you're in a fit regime, flexible inflation targeting, you're responding to persistent inflation and you're keeping a real rate positive. Then it's credible that you're going to act against inflation and that inflation target should get anchored. There are already signs. I have a recent research paper showing that firms passed through supply shocks has really fallen in the inflation targeting period. So again, there was a question in the chat box that RBI just hopes and keeps rates high. They did overshoot last year, but overall, if you keep real rates at 1, you're not overshooting or keeping rates too high. You're credibly anchoring inflation expectations. So RBI in this supply shock regime lowers inflation not just by tightening aggregate demand, but by communicating that there is an inflation target and we're going to act to ensure that is achieved. Yeah. So now if your inflation is below the target as it is currently, that means you are growing at less than your potential output. You can expand output without raising inflation. That's the only constraint, right? So we don't know. And again, I have a research paper on this, and there is a whole, even, other some US economists, Woodward and so on, have written on this, Swenson, that you should use inflation to infer your potential output. So to say that our potential output is 6.5 and so on, we don't know what it is. If inflation is low, real real rates can be reduced, nominal rates can be reduced, real rates stay near neutral, growth can rise. Yeah. And as long as inflation doesn't rise, we keep rates low, and that stimulates growth. Yeah. So we discover potential output from the inflation outcomes and responding to it. Okay. And then so this is what I have to say for Tarun's question to Upasna. And in the chatbot, there are a lot of questions on unemployment. That all right, whatever is happening, we have high growth. Why isn't employment growing? Now, again, another issue I like to emphasize is that in an emerging market, growth is very often very volatile. And we saw this through the 2010s because there's policy overreaction, over stimulus after the global financial crisis, then over tightening. So that G, although transitional growth is much higher, it's very volatile. And firms don't like uncertainty. They don't like volatile growth, even to plan their bench capacity and employment, etc. So if you see the recent unemployment figures, a lot of improvement, a lot of surveys, even the MSME surveys, this government portal on it is showing an improvement in 2024, 23-24 as we had sustained high growth after the pandemic. And that is why I say it's very important to smooth growth, because then firms start employing, investing, and better quality jobs get created. So we had over tightening and some slowdown last year, but if we are able to, currently there are a lot of monetary fiscal push, other kinds of support for growth, and over time we should see that materializing, and then we will see higher employment also. Already there are signs of that. Then there's another question about vegetable prices, and that policy should not be hostage to vegetable prices. Now here, when I was in the MPC, again, we did suffer from those potato, onion, tomato pot or top or whatever, those spikes, but those are temporary. They have a very short cropping cycle, so you can look through. And we did look through that in 23 and so on. We didn't raise rates because of that inflation, and it passed. But that, I think, contributed to this, that we must reach 4% before we cut, which led to real rates becoming too high. But in the meanwhile, I've been seeing that there is a lot of action on, diversification of agricultural crops towards horticulture, and improvement in supply chains. A lot of states, all the focus is on Punjab and the agitations there on MSP and so on. A lot of states have enabled, improved, or allowed private marketing and farm gate sales, and there are a lot of young entrepreneurs, using the internet and new technology to reach farmers. And so I think we are seeing improvements in the vegetable supply chain, and this is going to reduce these kind of price spikes. And that's again a sign of maturity, where the whole economy should not be suffer because of 2 or 3 vegetables. Inflation should not, and we'll see that the headline index will also be updated with the share of food comes down, the new index. So anyway, as I promised, now I think I've answered a few of the questions in the box. I hope Upasna and Arjun, you have seen. So now let's go reverse. Arjun, you go first. You answer any question that you would like to, and then Upasna will come.
Yeah, so I was actually thinking of the same point that you mentioned on CBI. So there was actually a very interesting RBI paper, I think in 2017 or 18, where they'd actually seen what actually drove inflation and the logic for this how vegetables are actually a part of it. So very interesting, they noticed that when rural wage growth actually starts picking up, they try to break that down and see which item starts picking up. So very interestingly, they said they figured that it was mason wages that were going up, and that trickled down into every other category. And there seemed to be a fair bit of an increase in wages because of rural real estate construction or other pickup in a certain sense, and that trickled down into vegetable prices. So that was a very interesting take that I remember reading, where they explained the increase in rural wage growth, that leading to more demand for vegetables, and that leading to vegetable price increase. So that seemed to be a very interesting one. So the other question that I noticed, a lot of questions they seem to be on US fiscal. So one thing that I can, at least that we've seen from a market's point of view, the last 2-3 months, US and Japan seem to be very similar in the sense that both these central banks have been clawing back on their purchases of their own government securities. So the Bank of Japan has been clawing back on their JGB purchases. US from nearly around 22% of their government securities they were buying. They're buying only around 16% or so, and with the absolute fiscal deficit number in the US going higher and higher, the primary dealers who also sort of participate, they're not able to actually partake as much as they used to. So there's been this narrative about how both these bond markets are getting increasingly price sensitive, explaining why yields are not really coming off and yields are remaining fairly elevated in a certain sense. So that I thought that was another point that came to me when somebody had asked about the US fiscal situation, because it's not likely to change, at least for the next decade. It's expected to be at around 6.5% or so. These were two. Third, there was one question that came to my mind that actually I wanted to ask you, ma'am, was on India, whether it is more sensitive to monetary or fiscal, because there was just a question of this transmission, so that came to my mind. I remember a very, very long time ago during my college days, I remember the ISLM curve, and we were trying to see for India whether the ISLM, what is actually good for India. And I vaguely sort of remember that we seem to be more sensitive or responsive to fiscal rather than monetary. And why fiscal should be the way out for India was a thought that came to my mind. I wanted your views on that.
Okay, I've been speaking a lot. Anyway, I'll see if we have time. Sharon gives us time, we can answer your question. But Upasna, any questions in the chat group? I'm really happy to see the range of questions in the chat and the degree of interest. Upasna, you want to take up any questions that have not been addressed?
I think one question on the economy, if I can answer, basically, like I think you did mention about employment, right? Which is very important for the way forward. What has really happened in the last 4-5 years, basically, if we just compare the kind of incremental shift in employment that is happening, it is happening away from a high-paying job to a relatively low-paying job. So the quality of jobs created is something which is not looking very promising. And that's where I get a little skeptical on. I think, IT sector, which used to be a very big employer, is also now becoming, very tepid in terms of its employment. If I look at, the share of employment, which is getting, even the PLFS survey that comes out, that also, if you look at the change in the employment from 2024 to 2019, that change that has happened, apart from agriculture, all other segments, all of the sector-wise employment that has happened has fallen. So the employed people is falling. So the higher paying people are less and less comparatively. So I guess there is some kind of a limit that we will hit to the consumption-driven growth at some point if we don't really bounce back to investment-driven growth. So that's where the challenge lies. While, yes, our leverage ratios for the households is much lower than the global side, if we were to compare, and hence there is a lot of room to leverage. But I think in transition, this may become a challenge, structural challenge, as we talk about. I think from a fiscal and a monetary perspective, my recommendation would be that the pace of fiscal consolidation ideally should be now reduced. We should not consolidate more significantly at the top level, and try and balance it out, because eventually monetary tools are more cyclical supports, and we should be providing the stimulus, right kind of stimulus, targeted stimulus, to ensure that the economy is stabilizing at a level which is necessarily. So I agree that the growth will happen, and probably we'll find newer sources of growth, newer sectors of growth. But the point is, if other traditional sectors are weakening significantly, then the offsets may not be immediate, especially in an environment which is globally not looking very benign. So we need, domestic factors to be holding up significantly to see incremental growth from here. Otherwise, it's largely dependent on consumers and the quality, as I said, of income. The income growth on the urban side is not looking great. It's only the rural growth, wage growth, which is holding up well. So all of this also needs to be kept in perspective when we look at, the way forward.
Okay, thank you. Thank you, Upasna. So I'll just come in quickly. Charan, will you give me 5 minutes? You're at 5 o'clock. Yeah. So
Such a good learning.
Tie up a few questions here. Your question, Arjun, is macro of fiscal. I think Upasna was talking about the same thing. So I've been arguing that in India, fiscal affects the supply side, inflation more. And because we have one of the highest combined fiscal deficits, state and center. Right, so there are limits, and our share of interest payments, because 8% the US Fed borrows at 4% and so on. So the share of interest payments in the government budget is very large, and that reduces what is available for them to spend. So they cannot provide a stimulus. And after the pandemic, the deficit had really shot up. Right? It had to come down because that is what creates risk and then raises spreads and cost of borrowing for all firms, crowds them out, etc. So stimulus by increasing deficits is likely to be counterproductive. And therefore, it was correct to decrease deficits. But they did a very good job in providing stimulus by improving the composition of expenditure. This RBI paper you were talking about, Arjun, I also had some research on this. The 2010's huge inflation that we saw was because MSP prices were increased, huge amounts of government money going into funding rural construction, then that MJ Narega minimum wage was raised, etc. So, and it was actually nascent, I agree, it was non-agricultural, which wages rose, and this raised agricultural labor. So you had real wages rising at rates that were not seen in India for a long time. And everybody said there's a wonderful equality, this wage will create consumption, but it did not. It only increased agriculture because the demand was for agriculture where there were constraints. You had not liberalized agriculture. So it created such high inflation. There was overall macro fiscal financial tightening, and the economic growth slumped. So, Upasna, your question about the government stimulating growth through transfers or better jobs, or remember, we are 1 billion people. I think already we chose too much of subsidization, consumers as well as farmers. Given our size, the small percentage of productive people, which, compared to East Asia, China, where they focused on raising agricultural productivity, here it was transfers to farmers. Yeah. So where I say better composition of expenditure, what this government has chosen is to emphasize investment, infrastructure, reducing bottlenecks, and they've had the benefit of DBT, which allows targeted. I was just seeing some data, apparently it's on the ILO dashboard now, that they have reduced leakages by 3.5 lakh crore, some number I don't remember. But, and we know World Bank is showing that our consumption inequality has really fallen. We have most equal consumption because it's effective government transfers, food, as well as, various other services such as sanitation, piped water, etc., which improves productivity of people, right? Allows them to participate in the economy and the job opportunities and so on. So this kind of changes, and where you are able to reach specific kind of help to people who need it at a much lower cost, and you're able to spend on reducing bottlenecks in infrastructure. So all this is increasing our potential output, the non-inflationary growth that is possible. And the cyclical factors need to be such as to allow us to grow at that, kept at levels that allow us to grow at those higher levels. And that higher growth, along with improvement in human and physical infrastructure, will create better paying jobs. But instantly, if we have 1 billion people, we have a large working force, we have a lot of young entering the labor force, we have people transferring from agriculture to urban and with lower skills, you cannot expect their wages to reach advanced countries, or really high, because initially it has to be, at least their consumption levels are growing, poverty has fallen, they're able to buy much more, their consumption basket has expanded. And it will take time, and slowly it will improve further. But given the large numbers, this is what you expect in a market system, that wages can't suddenly rise beyond productivity. That's the recipe for inflation. Yeah, anyway, I think I've taken exactly 5 minutes. So now it's been a very good discussion, I think, and interaction, wonderful interest from the audience, also a lot of questions. So, Charan, you're hand it over to you.
Thank you. Thank you, Professor. This was long awaited. We had thought about this the day the rate cuts were done. And then, of course, the slots were so full that we couldn't find a slot for our own self. So strange. But luckily, we found one now. And such an excellent discussion. Thank you very much, Professor, for leading from the front. And of course, Arjun, you conceived the idea, and we now finally succeeded in having that discussion, consumption-led. That's so true. And thank you, Upasna, for agreeing in your busy schedule, coming and being with us. I know 5 o'clock was your deadline. You have another meeting to go. So I want to thank all of you. And of course, the panel has been so good. They've been also, I think, very informative with the data that they've shared with us. And of course, the questions have been very good, as Professor Goyal has mentioned. We are continuing our journey of the webinars. Next week, we are going to do one on Tripura. We are going to cover all the states, one after the other, as the slots become available. And I would welcome you for that. The important thing is that on 15th of August, Friday and 15th August are coming together. So we had a choice of having a holiday and relax, or we had a choice of really asking the economists to come and contribute on 15th August. So we chose the latter. And who's going to lead the panel? Professor Mahendra Dev from the Prime Minister's Economic Advisory Council. He will be leading the panel, and we are talking about India growth story, past, present, and future. And we'll have panelist Professor Satish Verma from North India, Professor Arpita Chaudhary from West Bengal, and D.K. Srivastava from South India. So in a way, we'll get a clear picture of the whole country talking about India's growth story, past, present, and future. And the time will, of course, be the same, which we always have, 4 to 5:30. I'm going to request you on 15th August, please make sure that we all economists prove our dedication to nation's growth and Viksit Bharat. Keep that in mind. August 1, we have a discussion on Tripura, and August 8, we are going to do a book discussion by Rajiv Kumar, who has just finished that book, and we are going to talk about it. This is on 8th in the evening again, 4 to 5:30. With that, let me thank each one of you. Our discussion today is very, very pedagogic. I'm sure some of us as professors are going to use it in our classrooms. I'm going to use it in my classroom. So the recording will be available tomorrow by noon on our website. So have a great weekend and see you all next week. And thanks to you all once again.
Thank you.
Thank you. Thanks a lot. Thanks a lot, man. Thanks, Mr. Singh. Thanks, Upasna. Bye.